All right, I'm back, guys. Now try to slow down. Try to slow down. Okay, I was saying here, fire. I was on the fire equipment, and I said on the 1st of June 2019, River Limited imported new fire. The following costs were paid by the cost price of the fire equipment is 250 rand. The import duties, the percentage of the the percentage of the cost price is 10%. So that means if you want to get the import duties, the amount of the import duties, we need to take the cost price and apply that 10% for us to get how much is the import duties. The delivery cost is costing 3,750. Installation cost is costing the same amount as delivery cost. And then we have the operator training cost, which is 6,000. And then I said to you, operator cost is not part, it will not form part of the cost price. So we must not include it in this cost price when you want to determine the new cost now. Because these cost prices, the new cost prices that we see there, like import duties, delivery cost, installation cost, they are going to affect our main cost price, which is 250 rand. So now we don't have to take the operator training cost into account. We have to leave it because it does not form part of the main cost price, which is 250 rand. Now what we have to do, we have to take the 250 and then we multiply it by 10%. By doing that, then we to get how much is 20,000. I said to have to cancel one. To say 250,000, multiplied by 10%, you're going to get 20. Import duties is equal to 25,000. It's 25,000 in this case. Then delivery cost is 3,750. Cost is 3,750 as well. So let's continue reading the adjustment. On the adjustment, they said the fire equipment is depreciated at 12%, at 12.5%. The fire equipment is depreciated at 12.5% per annum on the straight line method, meaning we're going to be using the cost price to determine the depreciation. We're going to use the cost price to determine the depreciation because of what? Because we are using the straight line, or it is on cost. So on the 1st of July 2019, the new fire equipment was ready for use, and it was used extinguishing the fire on the same day. On the 1st of November 2019, there was flooding at the factory, and an old fire equipment with a cost price of 150,000 was damaged and had to be written off. Meaning we treat one as the equipment was in the same way as we treat the sold asset or the disposed asset. If the asset got damaged or was damaged by fire, you treat that asset in the same way as you treat the disposed asset or the sold asset. Let's continue. Now you know that under fire equipment there was this equipment that was costing 150,000 that got damaged. That was damaged, and it was also written off. And then also you know that there are those three costs there, which is imperial cost, installation cost, that will affect the main cost. Even this one that was damaged, so it will affect our main cost. So you solution how to deal with that one and how to calculate that one. Let's jump into the plan they set under the plan on the 1st of November 2017. River Limited purchased land for 200,000 and a value of 5,000. Is a good people. If you want to calculate the depreciation and at the same time you are given with the residual value, you need to treat the residual value in the same way as you treat the accumulated depreciation. Meaning before, if they said we calculate the depreciation using the residual, the reducing balance method, you need to take the cost price, and then you subtract the residual value, the price, from the main cost price, which is 200,000 in this case of plant, because the cost price here for plant is 200,000. And also we are now told that there is a residual value of 5,000 rand here. So we need to treat it as in the same way as we treat the accumulated depreciation. So by saying that, I'm trying to say to you, you're going to take the 200,000, you subtract the residual value before you even apply the percentage of depreciation, of calculating the depreciation. So now the following statement says the plant was available for use as intended by management on the 1st of January 2018. The plant was available for use as intended by the management on the 1st of January 2018. Meaning the management said that this plant is supposed to be used or to be operating during this date, which is 1 January 2018. So it will be start working on this day. All right. So the following sentence the following line says the depreciation method on the plant is 10%. So this plant, it is depreciated at 10% per annum on the straight line method as well. Meaning we apply the percentage of depreciation on cost for us to get the depreciation amount. And then the directors on the 1st of January 2019 decided to revalue the plant to its gross replacement value of 207,500. I'm going to show you how to deal with a statement like this. If they said, if there is a gross replacement asset, right? The replacement value of a certain amount, you'll see today how to deal with those assets, right? Because the directors they are those who are taking the decisions, right? That is why you see here they said on the 1st of January, directors decided to revalue the plant to its gross replacement value of 207,500. You know that the original amount or the original cost of the plant is 200,000, meaning it is now being revalued. 7,500 was added on top of that 200,000, which is the original cost price of the plant. So going forward, they said to us with an estimated residual value of 7,500, meaning it was added. This is the amount that was added on top of the original cost of 200,000. Please, guys, forgive me. I can't talk slow. Okay. So now the residual value is 7,500, and then the residual the revaluation surplus will be realized through the use of the asset. Let me repeat that one. They said the revaluation surplus will be realized through the use of the asset. Okay. So now let's go ahead and check the following additional information. Additional information number 1. The South African Revenue Services allows the wear-and-tear on the plant and fire equipment at 20% per annum on the straight line method with no apportionment. With no apportionment. It means that you don't have to take the number of months into account when dealing with the wear-and-tear. That is why they said with no apportionment. You just take the cost price, you apply the percentage of the wear-and-tear, and then you're going to get the correct amount of the wear-and-tear. That is why they said no with no apportionment, meaning you don't take into account the issue of the months. Let's say that the asset was purchased during the year, meaning let's say it has 6 months. You do not calculate the number of months. You just take the cost, then you apply the percentage of wear-and-tear, just like that. Do not take the issue of months into account. So that's what I was trying to clarify here. So number 2, they said the property plant or PPE was revalued by Mr. M. Tamaga, something like that. I'm not used to this kind of surnames. Now, an independent valuer on the 1st of January 2019 using the gross replacement method. So this is the guy who revalued this PPE. As you can see on top there, it was revalued from 200,000 to 207,500. You saw under the plant there, and also the land there, it got revalued. So I'll go back there and show you how to deal with those amounts that were revalued by this man. So now, number 3, they said the land and office building are situated at the stand 234, Garankuwa Extension 2, Gauteng Province. We all know Garankuwa Extension 2, but I'm not there. Let's focus on the following one, which is number 4. Assume that the tax rate of 30% for the year under review and prior years. Okay, that means we're gonna be applying 30% for prior year from prior year amounts, even for the current year amounts. Right. So number 5, the capital gain inclusion is 50%. The capital gain inclusion is 50%. Now we are done reading this information, but let me give you just a few tips about this accounting thing. You know, here, the first thing that you must do, you must start by reading the requirements. What is required of you? You see that they said you are required to, number 1, to prepare and disclose the PPE notes in the annual financial statement of River Limited as at 31st December 2019 in accordance with IFRS and the Companies Act 2008. All right. So now you are required to prepare this thing. Before you even read the scenarios there, you start by reading the requirements. I'm just giving you the tip so that you'll know which one is easy for you. Let's say number 2 is easy. If you started reading the requirements, you'll know that, okay, I'll start by preparing and disclosing the revaluation surplus note on PPE in the annual financial statement of River Limited as at the end of the financial year. Okay, but in this case, we're going to start by requirement number 1, because I'm here to teach you how this thing is done. And then NB, or note, the comparative figures are not required, meaning the lecturer wants to see only the current year figures or amount. If they say comparative figures are not required, comparative figures are not required, meaning we don't want to see amounts for that belongs to previous years. We want to see the current year amounts. I mean, so the accounting policies are not required as well. Show all your calculations. Right? Show all your calculations. Meaning, if they say show all your calculations, it means that there will be marks that will be awarded for calculations. So be careful of those things. You start by reading the requirements, and also read what we have to take into account as these NPs here, where they say comparative figures are not required. So let me move back up. Let's start by discussing, because I believe that tomorrow, because you are writing tomorrow is Wednesday, we are writing tomorrow, so this is what you must be careful of. You must check the date above there. That date that says the asset register as of the 1st of January 2019. It tells you that the balances the balances that you see underneath there or below there are the balances at the beginning of the financial year. That is why I said to you that date there on top of that table is very, very important. Right. So you can see that office equipment. I want to deal with this land first. You see that the land at the beginning, it was costing the amount of 100,000. But when you go to the additional information, you can see that they said on the 1st of January 2019, the market value of the land was 150,000. It means that the land was revalued. If they say this is the market value now. So the land was revalued with this amount. So that is how you're going to get your revaluation surplus on land. Then the land was purchased on the 30th June 2018 and then brought into use on the same day. So let's get into the solution very quickly, and how to deal with these things and how to deal with the. I hope you got what I was saying here about the issue of the date. Tomorrow they will give you like similar to this one. Statement financial year end 31 December, and then they say asset register as of, then they'll mention the date. They can say as of 31 December 2019. So you must be careful of that. Sometimes they'll say 31 December 2018. Those are still balances at the beginning. If they say 31 December 2018, those are still the balances at the beginning for the following year, because the balances that we closed with last year will be our opening balances for the coming year or for the following year. So in this case, they made it clear. They said to us 1 January 2019. So we know that our financial year is starting on the 1st of January 2019. But tomorrow they might say these balances are at the end of 2018 December, meaning those amount will be our opening balances on the year of 2019. So let's get into the solution and try to solve everything. We're going to start by solving the issue of land, and I'll show you how simple it is. You can see that here under the land, the first thing that you have to record there. You can't just draw the table like this and then you put land, office, building, fire equipment, and so on. But you must mention that this information that is written below here is for what? Is for River Limited. That is the first thing that you must record on top or above this table. You're going to say River Limited. The statement for A and the 31st, and then you write PPE or plant and equipment. Then try to slow this left. The count at the beginning is 100,000. You have those plants so information to this is the accounting. This is the accounting register that is at the end. That is at the which is the 1st of January 2019. That is what we saw on where we were reading this the information of land. So here we have the cost price. On top we have the carrying value, but before the carrying value we had the cost price, which is also written as the gross carrying amount, meaning the cost in bracket. So this 100,000 was given. That is why it is highlighted with this color here. 100,000 was given on your information on top there. If you can go back there and check, you'll see that 100,000 was already there, meaning it was given. You're not going to be awarded any marks for the given amounts. You can see that here, under the balances, there was this 100,000, which is also highlighted here to show that there's no marks, there's no mark for the given amounts. So you just take this amount and you check the date above here, that the asset register is off as of the 1st of January 2019, meaning these balances are at the beginning. So when you get there under your PPE, you must record these balances at the beginning. All these amounts here, they must appear as amounts at the beginning, or they must appear in the beginning there or on top of your PPE. So 100,000 for land was given. Let's quickly go there. All right, so now on top there we have the cost price. Accumulated depreciation is 0. Why? Because it doesn't depreciate. The land does not depreciate. That is why we have the cost price, and then minus 0, we're going to get the carrying value of 100,000. 100 minus 0 accumulated depreciation, you're going to get the 100,000. It is simple as that. And then, do we have a depreciation for land? land, it doesn't depreciate. Land does not depreciate. Therefore, we have zero even for depreciation. And then how much is the revaluation for land? Let me tell you this. If they tell you that the land has the market value of this much, of 150,000, it means that the 150,000 must be recorded as the cost price at the end. Let me repeat that. If they tell you that the market value of the land is 150,000, that simply means that the 150,000 will appear as the cost price at the end. So I'm done with that one. And then the difference between the cost price at the beginning and the cost price at the end is going to give you the revaluation surplus. That is why you see the 50,000 in the middle there. And then do we have a disposal? We don't have it. This asset does not depreciate. Do we have any purchase asset during the year or additions? We don't have them. The only thing that we have is the residual, the revaluation. We don't have disposal, we don't have additions, we don't have depreciation. Be careful of that. I'm trying to explain everything as much as I can. Okay. So what I'm trying to say that we must be careful of these things, because someone can record this 50,000 in the space of additions, of which is wrong. That is wrong. You're not going to get any mark for that. You're going to be wrong. You're going to get the mark for the carrying amount, which is at the end, and also the gross carrying amount there, which is the cost price. You're going to get 1 mark there because they are awarding half marks. So be careful. If they said 150,000 is the market value, you must know that there must be a residual valuation surplus there if you have the market value of 150,000. So the difference between the market value and the cost price at the beginning for land is your what? Is a revaluation surplus. We have accumulated depreciation at the end for land. We don't have it. It doesn't depreciate. So we're done with this one for land now. So let's focus on the office building and see what is happening there. That one, I hope this one is clear. Difference between 150 and 100,000 is 50,000. Because the 150,000 was the market value. That is why it gives us the revaluation and not additions. Let me tell you this. Let's say that they've added or they've purchased the new land now of 150,000. That is the only time where we're going to get the additions. If they've purchased an additional land, we're going to get the additions of 50,000 rand. But this one was just a market value, meaning the land got revalued or was revalued. Okay. So now let's get into this one for office equipment. So the first thing that you must prepare is this PPE, the normal PPE that you know. Okay, let's get into the office equipment. Let's go back there and check something, because I want to take you step by step. And don't worry, this session is being recorded and will be posted on my YouTube channel. Go there and subscribe and like there. All right, so I'm coming to this information of the office building. Remember that on the office building, they said office buildings are depreciated at 10% per annum on the reducing balance method with no residual value. So there is no residual value on office building. This one is supposed to be clear. It's supposed to be straightforward and easy. No, simple. It's okay. So now office building is costing 400,000 at the beginning, and then the accumulated depreciation is 108,400. It's 108,400. That is your accumulated depreciation. Now this one is given 108,400 is given as your accumulated depreciation at the beginning. Then the cost price is also given as your cost price at the beginning as well. Remember, this is the information of the office building. And also know that the depreciation the percentage of the depreciation is 10% per annum on the reducing balance method with no residual value. So now you already know that for us to get to find the depreciation, all we have to do is this: you take the cost price, you subtract the accumulated depreciation. Why are we doing that? Because we know the method of depreciation is that it is on reducing. the method is reducing balance or decreasing balance or diminishing balance method. That's the same thing. So I told you that if the method is reducing balance, now we have to take the cost, subtract the accumulated depreciation. So we take the cost price, you subtract the accumulated depreciation. Let me repeat, for you to calculate the depreciation, if the method is reducing balance, you have to take the cost price of that particular asset, you subtract the accumulated depreciation before applying the 10% of the depreciation, as you can see it there. So I hope this one is simple and straightforward. So tomorrow, if they give you something like this, you must just collect those marks. Okay. So now, what we have to do now, we have to take the cost, which is 400,000, minus 108.
Can I ask something?
You're getting how much? Now we want to calculate the depreciation of the office building. Good people. I'm saying to you, they are using the reducing balance method. If they are using this method, it means that we have to take the cost price, you subtract the accumulated depreciation. It is clear before applying the percentage, which is 10% in this case. We want to determine how much is the depreciation. And then I got 291,600 as our carrying value. So we need to apply the percentage of 10% now. We need to say multiply by 10%. Remember what I said last time? I said you must cancel 1 0. You are using the 10%. Now let me just prove it. You see now, it's going to be 29160. So that's your depreciation for office building. This is your depreciation during the year. Let's quickly check that. Remember, the carrying amount was 291,600. And then from there, we applied the percentage, the depreciation percentage, which is 10% in this case. We said 291,600 multiplied by 10%. We got how much? We got 29160, 29,106. So that is our depreciation now. Let's go and check and confirm what I'm saying right now. You can see office building, by the way. You can the 400,000, which is the cost price was given. It was given this one, the 400,000. It was given. The cost price there. The inflation was also given one. Right. So you say 400,000 minus 108, 400. You're going to get a carrying amount of 291,600. This is your carrying amount. And then from the carrying amount, because we were told that to get the depreciation of the office building, we need to apply the reducing balance method. To get the depreciation for office building, we need to apply the reducing balance method or diminishing balance method or decreasing balance method in order for us to get the correct depreciation. Right. Now we take the carrying amount 291,600, we apply the 10%. We to get how much? 29160. So you just have to cancel the last zero there. Then you're going to get a 29160. Right. So that one is clear now and straightforward. So do we have any additions there? No, we don't have any additions. Do we have any revaluations? We don't have them. What we have? We have only depreciation here. So then we have carrying amount, we have cost price, which was given, we have accumulated depreciation, which was also given. Depreciation, we calculated this one. Now we don't have the revaluation surplus, we don't have disposal, we don't have additions. Let's then calculate the new cost price. For new cost price, we have to say the cost price, listen careful on this one. This is very, very, very helpful, this one. So you take the cost at the beginning plus the additions minus the cost of the sold asset. Not the carrying value of the sold asset, but you subtract the cost of the disposed asset. Let me repeat. For you to get the cost price at the end, you say the cost price at the beginning plus the additions you subtract the cost price of the disposed asset or of the sold asset. So you're going to get how much? You're going to get 400,000 because cost price is 400,000, disposal is 0, additions is 0. So I mean to say to you, say 400,000 plus 0 for additions minus 0 for disposal. You're going to get how much? 400,000 at the end. You see? I mean to say to you that the 400,000, which is the cost price of the office building, it is going to be only affected by other costs. Let me repeat, the cost price at the beginning, which is 400,000, it is only going to be affected. It is only affected by other cost prices, by other cost prices of what? Of office building. Right. Let's continue with the other one, which is the accumulated depreciation at the end, because we do have the accumulated at the beginning, but we don't have the one that is at the end. How do we then determine the accumulated at the end? That is the question that you'll be asking yourself tomorrow, but unfortunately I won't be there with you to assist you. So you must listen careful to whatever that I'm saying today. So now, to determine the accumulated depreciation at the end, I'm saying this thing slowly now. You have to take, you have to have the accumulated at the beginning and in the depreciation. I mean to say you take the 108,400 at the beginning there, as you accumulated at the beginning, you add the depreciation during the year. In that way, you're going to get how you're going to get how much? You're going to get the 137,560. Let me prove that one to you. I'm saying to you, you take how much? You take 108,400. You add the depreciation of 29,160. You see now, we are getting that 137,560. PPE is very simple, good people. However, this is where you're going to be collecting most marks. Okay. Now, I hope this one. I hope we are done with the office building. Can we move on the fire equipment? But there's this thing now. For you to get the carrying amount at the end, you say 100,000 minus 137,560. You're going to get how much? 262,440. Gross amount minus accumulated depreciation, the carrying amount at the end. Right. So let's continue with the fire equipment. You see now, every time I start calculating the new for new asset, I start on top here. I start with these balances that you see here. I started with the land, office building followed, and so you see that 475,000 or triple is your cost price for fire equipment. So you must take 475 and record it under fire equipment. And then also it has this one, which is 237,500 as you at the beginning. You must just do the copy and paste. Yes, do the copy and paste. So let's do it. The cost is 475. Accumulated is 237,500. That's what you must copy and paste right now. You see here, 475,000. That's your cost price at the beginning, which was given. 237,500. That's your accumulated, which was also given. We have 1 mark now, just by copying that information here and pasting it here. So now you say 475,000 minus 237,500. You're going to get 237,500 as your carrying amount. Let me repeat: 475, the cost price, minus accumulated depreciation 237,500, equal to 237,500 as well as your carrying amount at the beginning. Right. How do we then determine the depreciation now? That is your question. That is the question now that we're asking ourselves. How do we determine the depreciation? Okay, let's go back there. All right, so you can see that the fire equipment, it has the following cost prices. There's only one thing that we have to do here. There's only one important thing that we have to do here. We need to combine all these all the other cost, and you add them on top of this 250,000, which is the main cost. I mean to say to you, we have to take the 250 plus 3,750 plus 3,750 as well for installation cost. And also we have to add the 10%, which is for import duties. Remember last time we calculated the import duties. We got how much? We got 25,000. So in this case, we're going to say 25,000. I mean 250,000, which is the main cost. You add the import duties, meaning it is 10% out of that 250,000, which is the main cost. 250,000, the main cost, plus the import duties of 25,000, because we have already calculated this one. If you didn't listen, I said, I mean, to get the import duties, I said 250,000 multiplied.
So your mic is muted.
Yeah, he's no longer talking.
So your mic is muted.
Now, now I'm on this one for fire equipment. Yes. I'm saying to you, we need to determine how much is the depreciation of the fire equipment, in the same way as we did on the office building. Now we're dealing with what? The fire equipment. The principle is the same. You must know the principle, the rules of calculating depreciation and all these things. I'm saying to you, you were given with the amount of 250,000, and it is now affected by import duties, delivery cost, installation cost, operator training cost. It does not affect the cost price, right? You must go back to your notes and check these accounts that would affect your cost price. All right, so I said to you, you must take to determine the new cost. You say you take the main cost, which is 250,000. You add import duties of 25,000. You also add the delivery cost. You also add the installation cost, which is going to give you how much? 282,500. The installation cost plus delivery cost plus import duties plus 250,000 rand. You're going to get how much? 282,500. That is your new cost for fire equipment. Let's carry on now. The fire equipment is depreciated at 12.5% per annum on straight line method. Now you know I wrote that we have to take the cost price. From there, we apply the percentage to get the depreciation. Then let me continue. On the 1st of July 2019, the new equipment was ready for use, and it was used in extinguishing the fires on the same day, meaning it was brought into use on the same day, right? So on the 1st of November 2019, there was flooding at the factory, and old equipment. You can't see your screen.
It's your network. Check your connection.
Yeah, I can see the screen here. All right, so now make sure we have a good network on that on your side there. Can you please reload your Microsoft Teams if you're encountering some problems on your side or some difficulties? Now let me try to focus on the additional information for fire equipment there. The fire equipment is depreciated at 12.5%. Let me try to be slow. The fire equipment is depreciated at 12.5% per annum on straight line method. Now you know that for you to get or to calculate depreciation for fire equipment, you need to use the cost price, not the carrying value this time, because the method is straight line method now. Is on cost or straight line, right? So we don't have to get the carrying value here in this case because it is on straight line. I mean to say to you, you have to take the cost price and you apply the percentage of 12.5% here. On the 1st of July 2019, the new fire equipment was ready for use and it was used in it was damaged. The fire equipment of 150,000, it was damaged and had to be written off. So how do we then calculate the depreciation here? Let's quickly check there. I want to fix.
Sir, we can't hear anything.
Here they started by using the main cost, which is 282,500, which we have already calculated with you. So because we're using the straight line method on the fire equipment, we just apply the percentage on that cost price. That is why you see the 282,500 multiplied by 12.5%. Let's deal with this 6/12 now. Let me go back there and check. Where does this one come from? All right, you can see that they said on the 1st of July 2019, the new fire equipment was ready for use and it was intended. I mean, let me just read the statement on. It was ready for use on this day, 1 July 2019, meaning you start counting from 1 July up to December. That is where that 6/12 comes from. It comes from that day of 1 July. So now you have to say July, August, September, October, November, December. So that is 6 months. So that is why you see 6/12 there. Remember, they said show all your calculations. You'll get most marks there. More marks are there on your calculations. All right, so 282,500 multiplied by 12%, 12.5% multiplied by 6 over 12, which is from July up to December. Going to get 17,656. Here I'm trying to show you how to link the additions with the disposals, how to link them in terms of depreciation. Okay, so now let's jump into this one. You can see that the 475 is the original cost that was presented to you there as the balances under the balances at the beginning. 475, you know this amount. 475, it is there on top of the information. So they subtract the 150,000. I want to talk about this, the subtraction that you see there. Do not subtract the 150,000 from the 282,500. You subtract the disposal from the original cost. Let me repeat that statement. You do not subtract the disposed asset from the additions, but you subtract it from the original cost, which is 475,000 in this case. That is why you see 150,000.
So we don't say anything as case.
500. It is now subtracted from the 475 because this one is the main cost, which was
We can't see, sir.
which was before us. There.
We can't see.
You can't see the screen.
Check your connection.
Yeah.
Check your connection.
We can see the screen.
Check your network.
No, if others can see it, you also can, you
Your
also can see
network.
it. You must try to reload your Microsoft Teams, or maybe the network is not good on your side.
No.
But
See the
you
screen.
must just relax.
Can
This thing will be recorded. It's now recorded. It is going to be posted on my YouTube channel. Just
And
relax.
but we
Let
can't
me
see
finish.
that we're talking about.
Sorry.
We can't see where like you pointing because it shows us another information. You're talking about another information.
All right. So now I'm talking about. Okay, let me show you what I'm pointing here. Go down to the calculations of the. I'm here under the calculations of the fire equipment there.
Okay.
Yeah, I'm here under the fire equipment. That box there, it says historical cost, and then there are these amounts over there. But I'll solve that problem now.
Five, please switch off your camera.
So now I can I believe that you can all see what I'm talking about now. Okay, under fire equipment, there's this cost price under historical cost. There's 475,000. This one. 475,000, which is the cost price of the fire equipment. And also underneath that one, we have the 237,500. So you can see that we have the cost price and the accumulated depreciation. If you are doing the calculations, you must record them separately. Under PPE, you combine them all. But to show the calculations, you must record them separately for you to get more marks. So the cost price, which is also there, appearing under the PPE there, 237,500. Below, we have the balance of the 237,500 as well. This one. And then underneath, you have the additions, 282,500. where we're busy adding the installation cost, delivery cost, import duties on top of that 250,000. So this is how we got the 282,500. Because the operator training cost was not, it doesn't form part of the cost prices. Now I'm showing you how to get the depreciation, where you have the additions, balance at the beginning, and also the disposals at the same time. How to calculate the depreciation, the correct amount of depreciation? Look at this one and pay attention. 282,500, we applied the 12.5% and also 6 over 12. Because this one was purchased on the 1st of July, up until it was there during this current year, during this year, it was there from July up until December. So when you are counting, you count from July, August, September, October, November, December, that's 6 months. So 282,500 multiplied by 12.5%, multiplied by 6 over 12, starting from July up to December. You're going to get 17,656. Let's go on this one of original cost, 475,000 minus. Then you subtract the one that was destroyed by fire. You subtract 150 because it is no longer existing in the company. It is no longer what existing in the company. So that's why we are subtracting it from other asset, from other fire equipment. So 475 minus 150,000. Then from there we can then multiply it by the percentage, by depreciation percentage, which is 12.5%. 475 minus 150,000 multiplied by 12.5%. To be safe there, you have to start by opening the brackets, because your calculator is going to use Bodmer's rule. If you just put all the signs together, you must say 475,000. Now I'm teaching you how to use your calculator now, of which is wrong. You open bracket, you put in the 475,000 for you to get the correct amounts. You open brackets, you punch 475,000, you subtract the 150,000, you close your brackets, then you multiply by the percentage. That is how this thing is done, to get correct answers all the time. Right? You can see some people, they used to get wrong answers. But when you check their calculations, they are correct. Calculations are correct, but the problem is your calculator. Because your calculator is using Bodmer's. You must always put brackets, if you are dealing with the different signs. So you got how much? You got 40,625. That's your depreciation based on the original cost. And then under that one, for disposal, 150,000. This one is the one that got diminished. That was diminished because of fire. So you take the 150,000, you multiply it by 12.5%, multiply by 10 over 12. Let me deal with this issue of months. This thing is very, very important, good people, in accounting as a whole. It's very, very important, the thing of issue of months. Okay, let me go back and check where does this 10 over 12 comes from. Let's go there together. My computer is a little bit slow, but today is better than last time. Okay. Pay attention to this thing and listen to me very carefully. On the 1st of November 2019, there was flooding at the factory. I'm slow now. On the 1st of November 2019, there was flooding or floods at the factory, and an old equipment with a cost price of 150,000 was damaged. But I'm not interested in that. I'm interested on this date of 1 November. If you want to calculate the depreciation, I know that some the PPE is a problem to to most of you. But listen on this statement here. For you to calculate the depreciation for the disposed asset or for the damaged asset, I said to you when I was starting here, I said to you, you must treat the damaged asset in the same way as you treat the disposed one, right? So when calculating the months based on the disposed asset or the damaged asset, you do not start on the 1st of November. That is very important to take note of. You don't start on the 1st of November. Where do you then start? You start at the beginning of the year. You don't start where the asset got damaged. It was damaged during this day of 1 November 2019, meaning it was no longer there on the 1st of November. It existed before 1 November, but after 1 November and during that day, it was already fucked up. I don't know if, I'm not sure if that language is allowed here, but please forgive me on that one. So for the disposal or this damaged asset, you start counting from the beginning up until the day before it got damaged or the day before it was damaged. Let me repeat that statement. For you to calculate the correct number of months based on the disposal or damaged asset, you do not start when it was damaged, but you start from the beginning of the financial period, which is the 1st of January. And then you start there, you end counting on the day before it was damaged. In this case, you start counting from January. This one, this counting rules, it only applies on the disposal or damaged asset. I mean to say to you, if you want to count for the fire equipment which was damaged, start from January, February, March, April, May, June, July, August, September, October, yeah, October the 30th or 31st, I'm not sure. But to end counting on October, on the month of October. You don't count in November, because during November, on the 1st of November, the asset was no longer existing in the company. It was already damaged. It doesn't matter the time of the day, even if they can say in the afternoon on this day, but we're still going to count this day. Meaning you're counting out November. You start from the beginning of the financial year, from January up to October. You don't count November. I hope that one is clear. So that is why you see the 10/12 there on that solution. So yeah, 150,000 multiplied by 12.5%, multiplied by 10/12. You're going to get 15,625. And then you combine all these depreciations. You combine them all, and then they will give you how much? 73,906. You combine the one, you say 17,656 plus 40,625 plus 15,625 as well. You're going to get 73,906. It is simple as that. Very, very simple. You can see that just by saying 250,000, determining the new cost based on 250,000, just by saying 250,000 plus 250 multiplied by 10% plus 3,750, and also this one, you're going to get the full mark by doing that. So you must always show your calculations. Start by reading what is required of you. Start by reading the requirements. All right, so that is it for depreciation tools. If you can go back there, you can see that 73,906 is your depreciation. That is how you can get the depreciation if you have the disposal or the damaged amount or the additions and the additions as well. Don't be confused on that one. Don't get confused. Now we have this one for disposal now. You know very well that for us to get the disposal, we do not record the cost price of disposal of the disposed amount or the diminished amount, right? But you need to calculate the carrying amount. I mean to say, we're going to take the 550,000, multiply the accumulated depreciation. The answer that you are going to get there is the one that needs to be recorded as your disposal. We record the carrying value next to disposal. I hope this thing is clear to you now. Let me say it slow. For you to get the correct disposal, you need to take the cost price of that diminished asset or disposed asset. You subtract all the accumulated depreciation, the total accumulated depreciation for that disposed or diminished asset. You subtract it, and then you're going to get the carrying amount. And then that carrying amount is the one that needs to be recorded next to the disposal, which you see here. I'm referring to this disposal, this one here. I hope this one is clear. And then how do we then get the 59,375 as your disposal now? Let's get back there. You can see that it is written disposal, the number 3, under fire equipment. Those are the calculations that I'm dealing with right now. Under disposal, the number 3, we have cost price, which is 150,000, which was also given there under the information. You have seen it under the additional information. Then they said accumulated depreciation 150,000 multiplied by 12,5 multiplied by 4 years. So the 4 years is going to be an issue right now. I need to show you how to calculate, how to know that you have to multiply it by 4 years. All right. Let's go back there. Because now we mean to say that this asset which got diminished or which was diminished, it was depreciated for 4 years already. It has been depreciating for 4 years. That's what we are trying to say here, right? So we need to know, when was this fire equipment that got diminished purchased? When was it purchased? For you to be able to determine this to get, these 4 years, you have to know when was this fire equipment purchased. And then you start counting from the purchases, from the date of purchase up until its last day of its existence. Right? So you start from that date of purchase of this diminished fire equipment up until its last day in the compound, which is October. All right, so let's quickly go there and check how to get this 4 years. Okay, here we have the fire equipment, which is depreciated at 12%, 12.5% per annum on the straight line method. So if you want to convert the percentage of depreciation, you have to use the 100%, and then you divide the percentage for depreciation. For you to determine the number of years for this asset to remain useful in the compound, or for you to determine the useful life of an asset, you need to say 100%, just 100, divided by 12%. You divide it by 12%. You're going to get the number of years for this asset to continue being useful in the compound. So after those number of years, after the useful life, the asset will be on its scrap value. Will be on it what scrap value. So now you say 100 divided by 12,5. Of course, you're going to get 8, if I'm not mistaken. You are getting 8. So what is going to happen is this. The first thing that we need to know now, you need to know when was this asset, 151, when was it purchased? The date is not here. You're supposed to be telling us when was this asset purchased, right? Because this one is an old equipment. They say an old fire equipment. This one is an old fire equipment. This one that got damaged, or that was damaged. So, so this one multiplied by 12%, you multiply that amount by 12%, but I'm trying to get the date there, meaning that they mean to say 4 years has already passed since we bought this fire equipment. All right, guys, I'm still here. I was still solving something here, but anyway, I'm still available. Now, I'm trying to solve the issue because someone was asking me this thing of 4 years. How do we get this one? Okay, the solution is here. As you can see that here there's this one, there's this 150 multiply 150,000 multiplied by 12.5%, multiplied by 4 years. Then how do we then get the 4 years? You go back there on the first information, you check that depreciation. Okay. We have this accumulated depreciation for fire equipment, which is 237,500. This one will determine the period for this fire equipment. It has been in this company, and then the accumulated depreciation will tell us it has been here for how long. This accumulated depreciation is 237,500 is going to tell us how long this asset has been here. This asset has been here for how long? Has been existed for how long in this company? So you take that depreciation. Let me take you back there. So you say if you have your calculators there, or you have to take the punch this amount on your calculator as your accumulated depreciation. You say 237,500. You go back there. You divide it by the depreciation. So you divide it by the 59,037. Let me check this one. Divided by wait there, I'm still solving this one. It's a 237,500 multiplied by how much? Let me check the percentage, because it is very important to know where does that 4 comes from. Okay.
So I checked the communication box. They wrote it. They typed it in.
Wait, I'm still solving something. I'll attend you. Okay, so now, what are you guys saying? Okay, so now you go back there, you check that, you take that, because this one is calculated on a straight line method. So you're going to take that cost price, then we multiply it by the percentage in order for us to get the full depreciation now. You take the 237, you take the 475,000, the original cost price. You multiply that one by the percentage, which is 12.5%. We need to see the overall depreciation, the total depreciation, amount of depreciation, I mean. So you take the 475,000, multiply by 12.5% because it is on the straight line method, right? You're going to get how much? You're going to get a 59375. And then from there, you're going to take the same cost price, say 475, divided by, how much is this amount? Divided by, yes, you take that amount, you divide it by how much? Let me go back there. So for you to get the years now, because you already have that depreciation of 59,375, and also have the accumulated depreciation. We want to determine the number of years. Take the 2375, the 237,500, 237,500. You divide it by the depreciation, which is 59,375. Going to get the 4 years, which you see there. So it is the accumulated depreciation at the beginning, divided by the depreciation, by this amount of depreciation, right? Because when you say 475,000 multiplied by 12%, you're going to get how much? 59,375, right? So from there, you need to take, for you to get a number of years, to get that 4 years, which you see there, you take the accumulated depreciation, you divide that depreciation, accumulated depreciation of 237,500 divided by the 59,375. I'm not referring to the 59,000 of the disposal, but I'm referring to the one that I got by saying 475,000 multiplied by 12%, 12.5%. I'm referring to that one because we're using the straight line method. And then from there, you take the accumulated depreciation at the beginning, you divide it by the depreciation which you got using the 475,000 and the percentage there. So by dividing those ones, you're going to get the 4 years. So let's go back there on that calculation. All right, so now we have the disposal cost price 150,000 given, accumulated depreciation for the disposal now. You're going to say 150,000 multiplied by 12.5%, multiplied by 4 years, right? Multiplied by 4 years. So this is the 4 years that we are calculating. Yeah, this is the one that you are getting, guys. I see you there. I see you. So now the current depreciation now. How much is the current depreciation? You go back to this information here. Disposal, this is the depreciation, 15,625. Now you already know how much is the depreciation for the disposal. Depreciation for disposal is 15,625. You carry this one forward here. 15,625. 75,000, we calculated the 75,000 by saying 150,000 multiplied by 12.5%, multiplied by 4 years. We got 75,000. From there, we have to have this 15,625. So we say 150,000 minus minus 150,000. Someone is disturbing me. 150,000 minus 75,000 minus 15,625. You're going to get the 59,375. Right? That is how you're going to get your disposal value. As I was telling you that this disposal value, you take the cost, you subtract what? The accumulated depreciation at the end. That is how you're going to get the disposable value or disposable amount. meaning it has to be at its carrying value. So that is why you see the 59,363.75 on top there. Let me go back there and show you what I'm talking about. Here you see this 59,375. This is the one that we are calculating there under the disposal. So now to get the 282,500, or this one we've already calculated this one by combining those menu costs there. Delivery cost, installation cost, import duties there. That is how we got this 282. So we've added that, we've added those cost on top of that 250,000 rand. And then how much is then the cost price at the end? This one is very, very interesting, good people. Remember, to determine the cost price, remember what I said on the office building. You will see that we are applying the same rule for all these assets. It doesn't matter whether it's land and building or equipment or vehicle or bicycle or what. But we apply the same principle to determine depreciation, accumulated depreciation, cost prices, and so on. But we use the same principle. There's nothing that is going to change here. Okay, so let me show you this. For you to determine the cost price at the end, we take 475,000 plus 282,500 minus that 150,000 rand. Not this one, because this one is it carrying value. This one is a carrying value, this one, 59,375. You take the 475 minus the additions, then you subtract the disposal, the cost price of the disposed asset. Not this one, because this one is carrying value, this one. 59,375 is the carrying value. It is representing the carrying value of the disposable value there. It means that this asset that got damaged, that was damaged by fire, if you were to sell that asset as a company, if you were to sell that asset, we're going to sell it at 59,375. That is why you see this 59,375. If you wanted to sell that asset that got damaged, that was damaged, 59,375. That is the meaning of this amount, of this 59,375. But to determine the cost price, you only combine only the cost of an asset. You don't mix you don't include you don't involve the accumulated depreciation to determine the cost price, but you only combine only cost prices of the same asset. 475,000 as the cost at the beginning, plus the additions there, minus the cost of the disposed asset. Cost price at the beginning, plus the additions, which you see there, 282,500, minus the 150. You subtract the cost price, not the carrying value. So I'm done with this one, with the fire equipment. I don't want to waste time. The question that I'm doing here, I'm doing the one that Mr. Lala said we must do. It was posted there in the group, in your group there. You are the one who said I must do this question, so I'm doing it now. Go check it out there in the group that was created.
So how did accumulated depreciation at the end?
Okay, yeah, I'm trying to calculate that one.
Oh, okay.
All right. You can see there is this accumulated depreciation here, where you take the 275 minus 73,906 minus 90,000, 626. All right, let's go back there and check something. How did he find the cost price? Okay. Okay, so now I'm trying to get that 90,000. That one, that is so below there. But the simple way to get this thing, tell me how much you get if you say the accumulated depreciation at the beginning plus the depreciation accumulated depreciation at the beginning plus the depreciation, which is 73,906. You subtract that one for disposal, for the diminished asset. Let me try to prove it with you guys. I want to make this thing clear to you. If I say 237, 500, I want to prove this thing, if it's correct or not. I can't teach you wrong things. I'll be risking with your future. So now let me go down there. Okay. All right, so you see that amount there. Let me talk about this one because I have the information here, what I'm doing now. So you take the 237.
Okay.
Yes, this one, you add the depreciation of 73,906, right? After that, you subtract the 75,000 under disposal there. 237,500 plus 73,906 minus 75,000, which is your accumulated depreciation under disposal, minus the depreciation there, which is 15,625. Your combined depreciation 62, yeah, 65. It is 20,625. Combine 75,000 as the 15,625, going to get the 90,625. That is how you get this 90,000 here. You combine the depreciation. Remember you recall that when if you're required to do the asset disposal, yeah. Last year they used to say you must prepare the asset disposal. We have to have the accumulated depreciation at the end for asset disposal. The accumulated, which you see here, which is 75,000 here, this one is at the beginning. This 15,625 is a depreciation during the year. So for you to get the depreciation, the accumulated at the end for disposal, you have to add the accumulated depreciation at the beginning, which is 75,000. Then you add 15,000. You add them together. How much they'll give you. That is how you get this amount. It's simple as that. So now you say the 237,500, which is the accumulated depreciation at the beginning, plus the depreciation during the year, which you see there, and also the 90,625, the one that you got by combining 75,000 together with 15,625. It is simple as that, right? That is how you get the 220,781. I hope that one is clear. Let me go back there and check. But I'm done. I think I'm done with this one for fire equipment, unless if you have questions there. So plant, I'm on plant now. The cost price is already there on top. This 200,000, we have half mark for just by recording this 200,000 rand. They give you half mark. Now let's go back there. You can see for plant, they gave us the 200,000, but never gave us what the accumulated. We don't have accumulated. We have 200,000 as the cost price. Then we have the accumulated depreciation for that plant. Okay, let's go there and check what is happening. But before we can even go, let's just go down there and read the information there. We might find something. Okay. There's something very, very important I need to teach you about the plant. They said on the 1st of November 2017, River Limited purchased or bought a plant for 200,000 rand with an estimated residual value of 5,000 rand. Right? Meaning you subtract there. You're going to take the 200,000. I'm trying to get 200,000 minus 5,000. You get this amount, and then you multiply. You use the percentage, right? Use the percentage of 10%. So there you have they say the plant was available for use as intended by management on the 1st of January 2018, right? Meaning this plant was supposed to be used during this day, 1 January 2018. The depreciation method on the plant is 10% per annum on straight line method. Directors on the 1st of January 2019 decided to revalue the plant to its gross replacement value of 207,500 with an estimated residual value of 7,500. And the revaluation surplus will be realized through the use of an asset. Okay, we'll solve listing of the gross replacement. So the gross replacement is the new cost. Is the new cost. The gross replacement there is the new cost of this plant. So pay attention on the solution now. I'm going to be explaining everything there. Once they give you the gross replacement amount of value, you must know that there is something that is being added, that is now being added on top of the original cost. The original cost here is 200,000 with its residual value of 5,000. The original cost is 200,000. Now, when they give you the gross replacement value, it will be above that original cost. They mean to say they've added the revaluation there. They've added something on top of the cost price. That is why you see the gross replacement value is 207,500 with an estimated residual value of 7,000, and the revaluation surplus will be realized through the use of an asset. You see, something was added on top of the original cost of 200,000. Let's get into it. You can see that there you had 200,000, but you didn't have the 19,000. How do you then get or determine that 19,500 as accumulated at the beginning? You need to take remember there we had a residual value of 5,000. You take the 200,000, you subtract the 5,000, which is the residual value. Last time I told you that you treat the residual value in the same way as you treat the accumulated depreciation. Meaning you take the 200,000, you subtract the 5,000, which is your residual value. Tomorrow, you must be very, 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 very careful when they give you the residual value. Before you even apply the percentage of depreciation, you take the original cost, not the gross, but you take the original cost. Don't take the gross replacement value. Take the original cost, which is 200,000, which is also written there on your PPE. You take it, you subtract the residual value of 5,000, you get 195,000. The percentage of depreciation there is on straight line as well. You take that 10%, you multiply this amount by 10. I told you that if you have many zeros, just cancel 1 0. If you are using 10%, you just have to cancel 1 0. The last one, the last digit there, which is only if it is 0. So you're going to get what? 19,500. That is why you see 19,500 there. That is how they got it. So 200,000 minus 19,500, you're going to get how much? 180,500, which you see on top there. 200,000 minus 19,500, you're going to get 180,500, which you see here. And then how do we then determine the depreciation now? And also the revaluation. Let's go down there and show you how to determine them. It's a long step, but I'll explain everything. You see now, once you have, let me start this thing like this. Once you have the gross replacement value, this is what you must do. Once you have the gross replacement value, this is what you must do. If you go back there, let me show you this thing of revaluation. Once you have the gross replacement value, that is what you must do. You see here, they said to us, the directors on the first, if this statement was not there, we were not going to do what you see there. We're not going to do what you see there. The directors on the 1st of January 2019 were doing that because of this statement here, which I'm highlighting. This statement is the cause why we're doing that thing, which you saw there. They said the directors on the 1st of January 2019 decided to revalue the plant to its gross replacement value of 207. What is this now? Okay, of 207,500 with an estimated residual value of 7,500. And the residual value, the valuation, surplus, will be realized through the use of the asset. You see, they said it will be realized. They didn't give us the actual amount of residual of the revaluation, but they said the revaluation surplus will be realized through the use of an asset, meaning we have to prepare that information which you saw there. It's a must for us to prepare that information in order for us to get the residual amount. The revaluation surplus amount. They only gave us the residual value here. Let's go there and show you what we mean by that. You see now, we have the 200,000, which is from your PPE and from your scenario there, from your information that was provided. And then accumulated depreciation is also there on your PPE, 19,500. You have a full mark there. These are your calculations. These are your calculations that you see now. You see, if they say show your calculations, they mean this thing that we're doing now. So more marks are on your calculations. You see now, 200,000 minus 19,500, going to get 180,500. This information is from a PPE. How do you then determine the 7,000? How do you then determine the 7,000? Let me show you. It is very, very simple, this thing. You see now, you have to say 207,000, which is your gross replacement value. You take that amount. Let me also calculate with you. You take the gross replacement value. Listen to that very carefully, because tomorrow you will see these amounts, these weights, these concept like gross replacement value or net replacement value. In this case, we are given the gross replacement value, not net replacement value. So now, how do we then deal with the gross replacement value? You take that amount for gross replacement, which is how much is 207,500,000, which you saw there under the information. You subtract what? Okay, you say minus, you open bracket, as you can see there. These are the bracket that I was talking about. For you to be safe, your calculator is using BODMAS rules. So now you say 207,500 minus, and you open bracket. You say 207,500 once again, right? You want to minus what? The residual value before applying the percentage. You're going to say minus 7,500. You close the brackets. So you're going to get how much? Multiplied by 10%. You're going to get 187,500, right? If you take the gross replacement value, you say minus, you open bracket, you bring back the same amount, which is the gross replacement value, which is 207,500. You subtract the residual value, which you saw there on the information. Let me go back and show you this 7,500. Where is it from? Check here. The gross is here. I mean, the residual value is here. They said the gross replacement value of 207,500 with an estimated residual value of 7,500. I always said this thing to you. I always say this thing to you, that you must start by subtracting the residual value before you even apply the percentage. You must subtract the residual value before you even apply the percentage of depreciation. That's what I said to you. And now, right now, that is what I'm doing right now. So now, let me go back. Let me quickly go back there. I want to finish this thing now, because I'm tired. So now you can see that for you to get the revaluation, you say we take the gross replacement value, you minus, you open bracket, you bring back the same amount of the gross, which is 207,500. You subtract the residual value now, which you saw there. Unless if it was not there, the residual value, you're going to use the gross, and then you apply the percentage straight there. All right there. So now, just because we had the residual value, that is why we are doing this thing here.
So the 7,000, where does it come from?
So now you multiply that information by 10%. You're going to get 187,500. And then remember, you had a balance. That is there at the beginning, which is 185,000, 180,500. Let's go there on your PPE. I'm going to take the questions now. I'm trying to finish off this thing real quickly. Now, when you check there on your PPE, you can see that the balance at the beginning, it was 180,000. After saying 200,000 minus 19,500, you got 180,000. So the amount that you got from your gross replacement value, you must get the difference between these two amounts. Meaning you're going to say 187,500 minus 180,500. You're going to get the revaluation surplus. Okay, so let me go back there one more time. Okay, so now you already have this balance here, 180,000. By saying 200,000 minus 19,500, you got 180,500. So you're now going to do the calculation for like here number 2. 207,500 minus, in bracket, you open bracket, 207,500 minus the residual value of 7,500. You close bracket to multiply it by, you multiply everything by 10%. You're going to get how much? You're going to get 187,000. 187,000. I'm trying to prove something for you. Minus, okay, multiplied by, and then minus on 207,500. Yes, so what you need here, you needed to get a depreciation for the gross replacement value. So the 10% that you see here, this 10% here, this 10%, I want to make this thing clear to you. The 10% that you see here, it is not multiplying this 207,500. It is multiplying the in brackets amounts, I mean. The 10%, that you see here, it is not multiplying this 207 here. It is multiplying the 207 minus 7,500 only. That is why you see the brackets there. So in other words, we need to say 207,500 minus 7,500. You're going to get how much? You're going to get 200,000. And then from 200,000, you say 200,000 multiplied by 10%. You're going to get how much? You're going to get 20,000. That is why I said you must cancel 1 0. So get 20,000. So from there, you say 207,500 minus 20,000. Going to get how much? 187,500. And then you take the balance at the beginning for the plant, which is 180,000. You get a difference between the amount that you are getting now and that balance. So 187,500 minus 180,500. You're going to get how much? 7,000. So that is your revaluation surplus. Right? That is your revaluation surplus. As you can see it here, 2 marks. And then when you say 180,500 plus 7,000, you're going to get 187 as your balance after revaluation. As your balance after revaluation. How do we then determine the wear and tear or depreciation? How do we then determine the depreciation? Someone says I must repeat how I got 187,500. Talk to me.
Can you please do the calculation where you get the 187? I don't understand it. I see the 180,500, but I don't see where the other 187 comes from.
So come again.
So you are saying 207,500 minus 207,500 again with the, that calculation for number 2. I don't get it at all, because what you're saying and what's on the memo is 2 different things. Please break it down for us.
All right. All right. So I hear what you are saying. So here they said, I'm saying to you, you must do this thing like this. Okay. You take the 207,500 and then you subtract the 2. You start by opening the bracket, and then never mind that 7,000 there. What I'm trying to say to you is that you take the 207,500, you say minus, and then you open bracket, and then the 207, you write the 207, you bring back this gross replacement value of 207,500. You bring it back inside the bracket. You subtract the residual value of 7,500. You're going to get how much? You're going to get 200,000. If you say 207,500 minus 7,500, you're going to get how much? 200,000. Now you are left with this thing. We left with 207,500. Forget about the mem. 500 minus the 200,000, right? You're going to get how much? You're going to get the 7,500. Okay. So here, what we need here, we need to get the depreciation of the gross replacement value. Let me start this thing like that. What we need to get here, we need to get the depreciation for the gross replacement value. How do we get that one now? We say 207, you must do that separately. 207 minus 7,500. You get how much? You get 200,000. I hope you are listening. You take 207
I'm
for
listening.
gross replacement value. 207 for gross. 207,500 minus the residual value. Do that separately. Forget about what is written in the memo. 207, the gross replacement value, minus the residual value of 7,500. You're gonna be left with how much? With 200,000 if you less 7,500. And then you say multiply by 10% on that 200,000 that you are left with after subtracting the residual value. Going to say 200,000, that's what you are left with. 200,000 multiplied by 10%. You're going to get how much? You're going to get 20,000, right? After getting 20,000, you can then say now 207,500 minus that 20,000, right? Are you still following?
Yes, I'm with you, sir.
You get 20,000. Now you take that 20,000, you subtract it from 207,500. You take that 20,000 because you set 207,500 minus 7,500. Multiply by 10%, you got 20,000.
That's right.
Now
Yes.
you take the 207 minus that 20,000 that you got there. You're going to get 187,500. And then you go back to your PPE. You check the balance at the beginning. The balance at the beginning there is 180,500. And then the difference between 187,500 minus 180,500, you're going to get how much? You're going to get the 7,000. Let me say this thing slow.
Thank you so much, sir. Now I understand.
You take 187,500, which you got there by saying 207,500 minus 20,000. You got 187. You then have, I mean, beginning 500, you're going to get 7,000. That one is clear now. So now, how do you then, so for you to get the balance after revaluation, you're going to say 180,500 plus 7,000, which is your revaluation surplus. The answer is 185,500. The depreciation, we've already got the depreciation of 20,000 by saying 207,500 minus 7,500 multiplied by 10%. That is how you're going to get the depreciation or the WNT. This one is supposed to be a WNT. Let me go back and check. This one is supposed to be a WNT. Oh, it's a depreciation. Let me go back and check and confirm this. Oh, it's a depreciation. It's a depreciation. So depreciation is 20,000 in bracket, and then you say 187 minus 20,000, you get how much? You get 160,500. Then you are done with the column of the totals. On this part of revaluation, you're going to move this 7,000 under revaluation here, as you can see here. And then you say the balance is here, the zeros that are here, or the dash that are here, plus the 7,000, you get the 7,000. Because there's nothing here next to the cost price. You only have the revaluation here during the year. You say revaluation plus those zeros, which you don't see there. 7,000, you move it forward there as your balance. So it is also going to serve as your balance after revaluation. That's why you see 7,000 here and 7,000 here. And then you calculate the depreciation on that one to see how much is then is your depreciation there. Right? Let me try to solve that one. That's how to get the depreciation. So we say 7 multiplied by 10. Let me go back to the information and check something. Okay, so let me go back and check there. I want to check something. But we're nearly done. $7,000. Okay, it's here. 10,000. This one. Blah 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 blah. Okay, so that 500 there. You're going to get it by saying the 20,000 minus 19,500. Let me go back there and confirm that. You see here, you have this balance here. It is 19,500 minus this one, 20,500. You look at the 500, which is here in bracket. Just by taking this depreciation here, subtract this one, you get the 500 here. You can also get it by taking this 7,000 here, and also the revaluation of 7,000. You take the 7,000 here, you minus the 7,500 for revaluation surplus. You can also do that. It is also fine like that. 7.5 minus 7,000, you can get this amount. 7.5 minus 7,000, you can get that amount. So then 7,500 minus 5,000, you're going to get 6,500. You just have to move these amounts here, this side. Right? So here we have 0, 180,500. You move this one to historical as 85,000. But it starts here. Under historical, you don't have residual values. Under historical, you don't have residual values, but you move the totals to this side. You move the total.
Is it still there?
Can I ask you a question, sir?
All right, you can ask. I had a problem with the network here. Sorry. Yes, you're welcome. Can you hear me? Okay, all right. So just guys, you have to move all your totals here. Column of the total.
Wait,
Move the historical.
Sir,
can
can
you
you
hear
please
me?
repeat?
Anyway, my network is bad. Can you hear me?
Yes, I can hear you.
Where does that this 500 coming from on depreciation warranty? Hello? Hello, sir.
I can't hear you. Yes, I'm listening.
7,500 minus 7,000.
7,000.
Yes, yes.
7,000.
Sir,
Yes,
can
yes.
you please repeat?
We take the 7,500 to subtract the 7,000 for evaluation surplus. You get that amount of 500,000 or 500 rand next to depreciation or warranty. 7,500 minus the 7,000 there. Then you say 7,000 minus 500 to get 6.5.
Sir,
And then from there.
sir, can you, because you cut it
on that, you didn't repeat the one of the 40,000, the accumulated depreciation at the end. This one, number 4, 200,000 times 20. You said it's the wear and tear. Then you were trying to find out, but you didn't say where the 40,000 comes from.
Yes, let me try to clarify that one. I forgot. So let me sort out the issue of 40,000 rand. You see, they said to us, wear and tear is costing how much? See that one, okay? That is the additional information number 1 there. It says the South African Revenue Services allows wear and tear on PPE, on plant and fire equipment at 20% per annum on a straight line method with no apportionment, meaning you don't take into account the number of months. So you just have to go there. You take the cost price of the plant. You know how much is the cost price, how much is the... So the plant is this one. The wear and tear is being applied, is applying or using the straight line method. If they are using the straight line method, it means they mean to say to us, use the cost price, apply the percentage of wear and tear on the cost price, on cost. You take 200,000, which is the original cost. You don't take the gross replacement value. You take the original cost, 200,000, multiply it by the percentage, which is 20%, because SARS does not realize the gross, does not allow gross replacement value. It only allows the original cost price of an asset, of any asset. So you take 200,000, multiply by the percentage of the wear and tear. You take the original cost. Tomorrow there will be so many cost prices there, but you must know which one that you must use to get this 40,000 here. 200,000, the original cost, which was there under the information of the plant. You multiply it by the 20%, which is the wear and tear percentage. They also said to us with no apportionment, meaning you don't consider the issue of the months. 200,000 multiplied by 20%, going to get 40,000. It's 40,000. Yeah, so let's carry on with this thing now. Under historical, you need to take this one of you take this information. It is under totals 200,000 and 19,000. Record it here under historical. Sorry. So much interest. Okay, so now I guess people are here. So 200,000 minus 19,500. Where do these amounts comes from? Where do this amount come from? I mean the 200,000 and 19,500. They come from the totals here, under the totals here. 200,000 and 19,500. So you just move this one to here under historical, as they are. You move the 180,500, the balance up, under, you move to historical. And the residual, it must not be recorded under historical. Residual value must not appear under historical. I'm repeating that. You take 200,000, 19,500, you put it under historical, even the balance there, which is 108,500 under historical as well. But in the space of residual value, you put 0 because it must not be recorded under historical. It's simple as that. So you can see that now you're going to say 180,500 plus 0 equal to this one. Do we have any new depreciation here? The answer is no. We still have that 19,500. So we bring that one forward. We bring that 19,500 forward here. So you say 180,500 minus 19,500 to going to get 161,000. But I need this one. So I don't have to see the lecture when the lecturer is marking your work. The lecturer must not see the 7,000 here for evaluation. Evaluation does not form part of the historicals. All right. They want to see the revaluation under totals and under revaluations here. As you can see, the 7,000 is here, the 7,000 is here under totals. But under the historicals, you must not record the 7,000 for evaluations. That one is clear. Let me move forward to the text field. You do the same thing. You know that. Let me talk about the additional information there. Number one, they said to us the text, the way and tear, they are using what? They are using the straight line method, meaning the way and tear will be constant, will be the same throughout all these years. Way and tear will be the same, will remain the same, will not change, because we are using the same cost price and we are not applying the number of months. It is with apportionment. You must not take into account the issue of the month of the months. So having this 40,000, right? So now 200,000 minus 1,000, which is this one, because we are using straight line method, so it doesn't change in the case of WNT, unless if we were calculating the depreciation. But in this case, it doesn't change because required to calculate the number of months. But here, in terms of the tax value, we are not required to calculate the number of months because they say it is with no apportionment. That is why we don't consider the number of months in terms of WNT calculations. So the WNT amount remain constant throughout all the years. That one is simple now. I hope you have heard that one. So the cost price is this one, 200,000 minus minus the WNT is equal to 160,000. Do we have any new revaluation here? It doesn't form part of the tax value. That is why you see 0 here. And then you say 160 plus 0, you're going to get 160 as well. So the 40,000, you keep on bringing back the 40,000. So 160 minus the 40,000, you're going to get 120,000. So we don't have to see the revaluation under historical and tax value. We don't have to see the revaluation under historical and tax value. We want to see the revaluation under this column. Differences now. You see that here you need the issue of the, I mean, of the tax rate there. Okay, so the difference between the two, how much? You say historical, you say tax value minus historical. You're getting how much? Let me also confirm this thing on my side to make sure that you pass the tomorrow's paper. Yes, 40,000. Oh, the principle says here, tax value minus historical to get the temporal differences. Tax value minus historical to get the temporal differences. So 200,000 minus 200,000, we have 0. 40,000 minus 19,500, we have 20,500. Then you calculate the deferred taxation using the percentage. I'm going to come on this one. Now I'm still dealing with the different temporal differences to make sure that you understand this thing. This one, 160,000 minus this one, minus 180,000, you're getting how much? You get 20,500, the same amount. Just because here you don't record the residual value here. So you take this amount here, not this one, you take this one in this case, 7,000 minus 0 here under tax value. You get 7,000. Look here, guys. There's no problem even if you can take the totals and tax value or the historical and tax value. So now you take the 7,000 minus 0 minus tax value. Let's use the totals minus the tax value. When we arrive at this point of revaluation, when we are dealing with the revaluation space here, we need to focus on the totals. The 7,000 minus 0 is equal to 7,000, right? Same thing even here. 187,500 minus 160,000. 187,500 minus 160,000. So let me try to prove that one. So 187,500 minus 160,000, 27,500. Your temporal difference is here. You keep on doing the one and the same thing. This one, 20,000 minus the 40,000, you get 20,000, of course. 167,500 minus 120,000, you're going to get the 47,500. And you can also get this amount by saying 27,000 plus this plus the 20,000, you're going to get the 47,500. And you can also get this one by saying 167,500 minus 120,000. You have to get this amount to prove this one. When you go down like when you go down like this, you must get this amount, and when you go like this, you must get the same amount. So it means that between the totals, the difference between the total and the tax value is going to give you your temporal difference. The difference between your total and your tax value is going to give you what? The difference. Minus one of total. Here you just move on from the to his residual values. We have only one residual value here. Just moving it here. Then we take the I mean not the residual value. I mean the revaluation surplus. Move it from here to here. Then you go back. We take the residual value. You subtract it from 7,000. You get the 500. All right. So let me deal with the issue of the deferred taxation or deferred tax. Just go back on the additional information and check something. I'm tired now. So there you have the tax rate. They have the tax rate. You check. You are now checking the tax rate. So number 4, they say assume that a tax rate of 30% for the year under review and prior years. So if they say under review, they mean to say for the current year you're using the 30%, even for the prior years or previous years, going to use the same percentage for current year and for previous years. So this is the tax rate. For us to determine how much is the deferred taxation, apply the tax rate of 30% in this case. It is 30% here in this case. Let's go back there and show you how to determine the deferred tax. You must go back and practice this thing. So from a temporal differences, you take the 20,500, you multiply it by 30%, which is your tax rate, going to get 6,150. Why are these amounts on credit? If your temporal difference is positive, your deferred taxation will be on credit side. If your temporal difference is negative amount, give you a negative amount, your deferred taxation will be on debit side. Let me repeat, if your temporal difference is positive, your deferred taxation will be on credit side. If your temporal difference is negative, your deferred taxation amount will be on debit side. It is simple as that. But you are applying the tax rate based on your temporal difference to determine the deferred taxation. You do the same thing, 20,500 multiplied by tax rate is 30%, 6,150. 7,000 multiplied by 0.3 or 30%. Don't be surprised if I'm saying 0.3. 0.3 is the same as 30%. I'm avoiding this thing of saying 30 divided by 100. It is time consuming, that one. So you have to say 7,000 multiplied by 30%. Going to get 2,100. On credit side as well, because this amount is positive. 27,500 multiplied by 30%, going to get this amount. Same thing, and so on and so on. So now this is the end of this activity now. So thank you so much for everyone who attended this class here. Thank you so much. The video will be uploaded on my YouTube channel. Go and check it out. But there you'll find Forex videos there. Don't mind them. Just focus on this one that I'll be uploading today. So thank you so much, good people. You can now exit. Unless if you have questions.
Danko.
Evaluation.
You can ask your question.
Just one question.
Please don't forget to upload it.
What's the name of the YouTube channel?
What's your name?
Sir?
Evaluation, the last part.
The question.
The name of your YouTube channel.
The name is Peeps of Africa. You can write it down. And please go and subscribe there as a way of saying thank you. Yeah, because you don't have money, or you have money to pay me.
Can you please repeat the name?
Peeps of Africa, P-I-P-S. Space.
Is it one word? Is it what? Oh, space.
Yeah, Peeps, like P-I-P-S, space.
You didn't do it for us.
Africa.
Sir, I have a question on the PPE note. Yes, sir. And they under plant, the last one on accumulated depreciation, this 40,000 here. So we're basically saying this 40,000 is wear and tear. So if you want to calculate under plant accumulated depreciation, we must calculate it under wear and tear.
Let me try to attach that one. I didn't see it. Okay. Okay. Wait. If we say the 19,000 plus, okay, how much is this one? Plus the 20. Plus the 20. Minus. Okay, you know what? If you can go back and check there on our calculations, let me take you back on that one. Remember the 500 that we got there?
Yes, sir.
You're taking the 500, then you combine it with yeah, 19,500 plus 20,000 plus 500, this one.
Oh, okay.
Yes, go back and you have to record it here. So my tip for today, let me give you the simple marks, the obvious marks that you're going to get tomorrow. Are you still there?
Yes.
So, under your PPE, this is what you must record. You must write these three sentences here. Land and building is situated at 10234 Karankuwa Extension 2, Gauteng Province. We have a mark for that. It is just a simple copy and paste. Number two, the plant was revalued by who, by so and so, and when. Okay, listen to this. This is what I used to do while I was still doing finance 3. So I used to say land and building is situated as 10,234 Karankua, blah, blah, blah. There is a mark for that. Then the second sentence is this one: the plant was revalued by Mr. So and so, an independent valuer. And then I'll go ahead and say, this revaluation, it took place on the 1st of January 2019. I was hoping I'll be doing that. So I'll get 1, 2, 3. And then on this one, property, plant, and equipment. But forget about this one. As long as you have the 1, 2, 3, because you may not get the correct amount here. The plant was revalued by Tamaha and then independent valuer. Then the third one would be this one. The revaluation.
Hi, can I ask about the depreciation
By
for
preparing
plant?
the PPE.
Hello? Hello?
Oh, yeah.
Hello?
This depreciation.
Depreciation for plant.
Okay. This one. Go back there and this one. 207,500 minus 3,500 multiplied by 10. You're going to get 20,000. That is how you got the 20,000.
The 10 is from where?
The 10%.
Okay, thank you.
Yeah.
Sir.
Do record too.
10%. Yeah, please, the class is recorded. So, yes, I'm listening.
No, the YouTube channel we got of Pips of Africa, it contains Forex recordings. It doesn't have
Yes,
accounting. Pardon?
I'm still recording this one. So,
oh, okay, thank you.
So this way.
So I have a question about this disposal of office buildings.
Yes, you're welcome.
How do you know that you need to calculate with these 4 years? Because it looks like it comes from far.
All right. That's a good question. So the first thing that you must take into account, and that you must note, they had to tell you that they were supposed to tell you that the fire, this plant, not plant, is it
Fire equipment.
Fire equipment, right? Yeah, fire equipment. They were supposed to tell you that it was purchased. When was this fire equipment purchased? The original date. But they didn't give that information. That information was hidden, right? So we're going to know that we have 4 years. We're going to start by calculating from the date of purchase up until today, up until its last day of existence. So we're going to start from the date of purchase. If they did told us here, but they didn't, unfortunately. Then I gave you the formula of calculating that. You must write.
Yes, I got the formula.
Oh, my head is very much tired.
So quiet.
Diamond.
407,000, 407,000. You calculate the depreciation, and then You go down there, you check how much is the percentage of depreciation based on fire equipment, because you don't know the number of years now. I'm trying to give you the formula. You take the cost price at the beginning, you find out how much is the depreciation for that cost at the beginning.
Yes.
75,000 multiplied by how much? How much is the percentage? 12.5%. 12.5 percent. You get how much? You get 59375, right?
Yes.
Yes. So after getting that amount, you already have the accumulated depreciation most above here. You have the 237,500, right?
Yes.
Beginning. So you take at the beginning, accumulated depreciation at the beginning, not at the end, and then you divide it by the depreciation.
I see. I see it. I see.
You divide.
Yeah. Got it.
Then good luck for tomorrow. So bye-bye, guys. I'm ending this session now. I wish you all the best tomorrow. Otherwise, I'm signing out now. See you on the next one.
Thank you.
Which is second semester.
So, the name of the on the YouTube, what should we search for?
So,
Okay.
is the Pips of Africa. So Pips like PIPS, and then space. You write off, and then space again, Africa. Pips of Africa, PIPS space OF space Africa.
I got it. You'll upload this video today?
Yes, today. Just that I have to eat now. I'm tired. After eating, obviously I will be uploading it.
Okay, no, thank you.
Others are uploaded like the lesson.
No, they are not uploaded. Those ones. You didn't attend.
No, I couldn't attend. Sir.
Okay, I'll make a short video. Maybe after parting, maybe I'll see. I'll make a short video about the show. Don't worry about that. This one will be available there. You'll keep on watching while you're still practicing.
Thank you very much, sir.
Yeah, thank you so much. Have a good luck tomorrow. All the best. Bring back those 90%.
Oh, they're coming down.
Yeah, thank you so much, man. Otherwise, I'll see you next time.
Thank you.